the fifth largest bank right now in the United States is a bank called US Bancorp, and it's not looking good. Okay, this is just my commentary. First of all, Warren Buffett owned 42 million shares of US Bancorp. They sold all of it. Okay, they saw things there that they didn't like. Most importantly, Charlie Munger said, we see real estate. Problems with commercial real estate. And did you know that 50% of all commercial real estate loans in the USA are from regional banks?
Greg Foss, an executive director of strategic initiatives at Validus Power Corporation and a well-known Bitcoin enthusiast, has expressed concern about the state of the banking sector in the United States. Foss believes that the crisis in the banking sector is still in its early stages, and there could be more collapses on the horizon. He points to US Bancorp, the fifth largest bank by assets in the US, as a potential next casualty of the crisis. Holdco Asset Management, a respected investor in the banking industry, recently issued a short sale report on US Bancorp, calling it the unsurfaced and unsoundest of them all. The report noted that the bank is poorly capitalized and is likely to have to raise capital and potentially cut its strong dividend in the near future. Like other banks, US Bancorp has a significant amount of unrealized losses in its balance sheets due to investing heavily in US Treasury bills and mortgage-backed securities when interest rates were low. The bank's ability to recover these losses depends on the Federal Reserve and the state of the economy. Foss believes that the collapses in the banking sector so far have been due to interest rate risks, and there is still credit risk in store for US banks. He discusses the causes of the crisis, the role of the Federal Reserve, and what to expect in the next phase of the crisis in a recent interview.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Always there is somebody to blame. I'll explain why they're going under first, and then we'll probably be able to, piece together the reasons pretty easily. So first of all, what people need to understand about banking, and this is ubiquitous across the world. It doesn't matter if you're a bank in Bulgaria versus a bank in Europe versus a bank in United States, okay? All banks have a tremendous amount of leverage, which is to say that for every $100 of loans they make, which on a bank's balance sheet, loans are assets, for every $100 of assets, they only hold $4 of their own equity capital. The other $96 is borrowed from other people, meaning it's borrowed from other depositors, right? Depositors essentially make loans to the bank. The bank takes these loans and then re-lends it out in effort to make what's called a net interest margin, right? They pay depositors a certain amount of money, a pretty minute spread over zero. Then they lend it out, and that spread is called your net interest margin. But they do it levered 25 times or more. How do I get 25 times? Again, $4 of equity capital on $100 of assets. There's your 25 times leverage. So those assets can change in dollar value, market value, due to a number of things. Primarily with banks, it's because of credit risk. It's because you lend money to a counterparty and their credit quality goes down, or their perceived credit quality goes down because the world enters a recession or whatever. That's credit risk. And that's reflected in things like a widening spread that you're supposed to lend to Plamen. Plamen goes to the bank. 2 years ago, Plamen can borrow at prime plus 2%. Now, because of changed conditions, including potentially the changed condition of Plamen, the proper rate is prime plus 4%. Well, that incremental 2%, which is not being charged on the loan, gets reflected in the price of the loan, which changes from $100, it goes down to, let's say, $90. So that essentially the yield makes up for the risk, the changed risk of Plamen. That's pretty simple, right? But the problem is when the mark to market goes from $100 down to $90, and you're only holding $4 of equity capital, that means the other $6 is depositors' money. Essentially, they've lost that money on a mark-to-market basis. That's credit risk. What's got the banks in trouble primarily in the United States and, globally is not because so much that the credit quality changed yet, it's because the interest rate environment changed. They were taking these short-term deposits and lending them out to long-term government borrowers at low interest rates. Now, here's the thing. They were able to capture an increased net interest margin because of the upward shape of the yield curve and because all the central banks were saying things like interest rates are going to remain lower for longer, right? Well, the bankers said, well, if they're going to remain lower for longer, I can take these deposits, move them out on the yield curve, and capture a larger net interest margin because of the shape of the yield curve, the upward sloping yield curve. Well, guess what? They were wrong because interest rates didn't remain lower for longer. In fact, interest rates have increased at the fastest pace in history. In history.
Yeah.
Okay, which means when interest rates go up, bond prices go down, which means the mark-to-market loss on the bank's balance sheet is substantial due to interest rate risk, not necessarily credit risk. Now, here's the problem. We haven't even hit the credit crisis yet, and banks have had to chew through a lot of their risk-absorbing equity capital because of interest rate risk. So the banks are undercapitalized.
During an interview, Foss was asked who should be held responsible for the banking sector crisis. Foss believes that the blame should be shared equally between risk managers of banks for mismatching short-term deposits with long-term bonds, and central bankers for assuring banks that interest rates would remain low. According to Foss, the unprecedented pace of the rate hikes and the ready-to-fail structure of the U.S. banking sector are both recipes for disaster, and we are bound to have more banking sector collapses soon. Foss also criticized Jim Cramer's take on the whole banking sector crisis in a tweet, stating that all banks are risky, even those that are considered well-managed, due to their leverage ratios.
You have to look at the bank management, the risk managers of the bank, and say, guys, you shouldn't have been mismatching short-term deposits with long-term treasury bonds. That's called gap interest rate risk management. But here's the problem. They were told interest rates are going to stay lower for longer. So there's a little bit of blame from the bank risk asset managers. There's definitely blame from the central bankers.
The way they communicated things and what they said that they're going to do.
Correct. And then here's the one that I think makes the most impact is not just the fact that they raised rates, but they went so fast. Again, the fastest in history. I sent out a tweet this morning that shows the growth of interest rates compared to other epochs in history, recent history. The point is, Plamen, the banks are in bad shape, but banks are always risky. Everyone assumes banks aren't risky, but how can you not be risky if you lever yourself 25 times? That's risky. That's the nature of banking. So maybe Americans or the world is waking up to how risky banking actually is. Famous American Henry Ford actually said, though, over 100 years ago, he said if the average American understood how banking works, there'd be a revolution in the morning. So this was 100 years ago. So you see, like, banking hasn't changed that much. It's just people don't understand. They take it for granted. Oh, these things are too big to fail. Some of them are too big to fail, but none of them, zero of them, are too big not to see their stock price go down. And this is my biggest thing, is that bank stock prices are mispriced, and they're still mispriced relative to the true risk that you are absorbing. So, you know, I don't think depositors in the short term are going to lose money. I don't think the U.S. can afford to let depositors participate in like a Cyprus type bail-in. But that doesn't mean that bank stocks can't continue to go way down. And you're seeing that. Even Warren Buffett has been selling his bank stocks. And, you know, he's the guy that says Jerome Powell's doing a good job. And by the same token, he's selling bank stocks because he thinks the banking system is blowing up. So one of those things doesn't add up, okay? Either Powell's doing a good job and bank stocks will be sound, or Powell's not doing a good job and bank stocks will continue to get weak. So Warren Buffett's talking out of both sides of his mouth. Or no, in the last 30 years, rather, 10,000 banks have either closed or merged. so that you go from 15,000 down to 5,000. There's still another 4,000 that they need to close or merge. That's what's going to happen. So the big banks will get bigger. The small banks will either go out of business or merge with another bank. And that makes the system more centralized. But in my opinion, this is one area where centralization is actually good, because banking is a very bad or tough business. And if you don't have a good banker, you fail quickly. And I think we're seeing that there's a lot of not good bankers in the United States. So I don't think we're through this by any means. Don't overthink things. Banking is risky. Interest rate risk has caused most of the problems. Credit risk is coming. And it's commercial real estate that could be the biggest problem. And 50% of loans in the USA for commercial real estate are on the books of the regional banks. So all of these things stacking up, I think we're just in the first innings of the bank crisis in the United States.
U.S. Bancorp is facing potential failure, which could have a ripple effect throughout the banking industry. The credit rating firm S&P Global recently downgraded the bank's long-term credit ratings from A+ to A, citing a narrowing performance advantage compared to its rivals. Although the bank generates higher earnings than its large regional peers, those peers have gained market share and delivered stable results, which has impacted U.S. Bancorp's outperformance. Additionally, the bank may need to build capital ratios to meet regulatory requirements by the end of next year if its assets grow. Do you believe U.S. Bancorp will be the next bank to fail in the ongoing banking sector crisis? Share your thoughts and comments on Greg Foss' interview in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.